So I want to start with a number. Tesla is worth $1.47 trillion. Trillion with a T. That makes it worth more than the next 29 largest car companies on Earth combined. Toyota, Volkswagen, GM, Ford, Mercedes, BMW, Honda, Hyundai. Keep going. Add 20 more. You still don't get to Tesla. And I just sat with that for a while because Tesla makes about 2% of the world's cars. 2%. But it holds almost half of all automotive market value globally. That's weird, right? That's a weird number. But okay, I've heard the explanation. Tesla's not really a car company, it's a tech company. The cars are only the platform. Fine. I accepted that for a long time. Most people do. Then I started digging into what happened last year, and I kept expecting to find the part that made it all make sense. Some hidden revenue stream, some margin no one was talking about, some breakthrough that would explain that gap. Instead, I found this. 2025 was Tesla's worst year by almost every measure. Sales down, profits collapsed, revenue declined for the first time ever, lost its title as the world's biggest EV maker, and the stock near all time highs. That's where this starts, with a gap that shouldn't exist and a system that keeps it going. Welcome back to Interconnected. I'm your host. Here's what I couldn't let go of. Every number in Tesla's business went the wrong direction last year. Fewer cars sold, way less profit. First revenue decline in company history. And a Chinese company most Americans can't even name took the crown as the world's biggest EV maker. Of course, the stock went up. I'm not being cute. That actually happened. The business got worse, the stock got more expensive. Now, I held the same view most people did. Tesla's a tech company. Don't compare it to Ford, compare it to Apple. The cars are the iPhone. They're the thing you build the ecosystem on. AI, autonomy, energy, robots. That's where the real value lives. And honestly, that framing made sense to me for years. Then I looked underneath it. This is part one of two. Today we're going through the numbers: sales, profits, valuation, market share, all of it. And we're going to try to figure out why none of it seems to matter to the stock price. In a follow up episode, we'll look at the promise that fills the gap, a promise that's been made every single year for a decade. But let's start with the numbers, because the numbers are where the cracks start to show up. Before I get into what's wrong, I want to be fair about what's right, because the bull case for Tesla isn't dumb. For a long time, it was one of the best investment ideas in modern history, and the people who believed it got genuinely rich. I want to tell you about one of them. Quick note, what follows is a composite. I talked to a bunch of people in this situation and combined their experiences into one voice. The facts are real. The details are drawn from real research. But this is one character built from several. So, Marcus, 42, software engineer in Austin. He bought Tesla shares in 2017 after test driving a Model 3 at a friend's house. He wasn't some finance guy running spreadsheet models. He just drove the car and thought, oh, this is different. This feels like the future. He put in $30,000. Big chunk of savings, but not totally crazy. By late 2021, worth over $400,000. He didn't sell. And look, why would he? Every person who said this can't last had been wrong every time. The thesis kept working. And the thing is, the thesis was working. Tesla did something genuinely incredible. 10 years ago, the whole auto industry thought EVs were a joke, rich people's toys. Tesla forced every major car company on Earth to completely rethink their strategy. That's real. You can't wave that away. And then there's Musk himself. SpaceX was supposed to be impossible. private rockets that land themselves, experts lined up to say it couldn't be done. He did it anyway. So when someone with that track record tells you he's going to revolutionize transportation, I mean, you kind of have to take it seriously. Betting against Musk has been a bad idea for 20 years, and the social proof is everywhere. Tesla is the most popular stock among individual investors. About 43% of shares are held by regular people, not institutions. That's wild for a company this size. Your neighbor owns it, your brother in law owns it. The guy at dinner has a story about how it paid off his mortgage. When everybody you know has made money on something, being skeptical just feels stubborn. Plus, the tech company framing gives you an answer for everything. Don't look at price to earnings. Don't compare it to Toyota. You're valuing an AI company, a robo-taxi network, a robot manufacturer, an energy platform. The cars are only one piece. And by that logic, the stock price isn't crazy, it's pricing in the future. I bought all of this. Seriously. I found it convincing. The believers weren't fools. They spotted a real revolution early. They bet on someone the establishment dismissed, and they made more money than most investors made in a lifetime. So I want to be clear about that, because what comes next isn't about diminishing what they saw. It's about what I found when I started looking into where the story falls apart. Okay, here are the numbers. Tesla delivered 1.64 million vehicles in 2025. That's down from 1.79 million the year before, and down from 1.81 million 2 straight years of decline. Never happened before in the company's history. And it's not like the EV market is shrinking. It's growing, especially in China and Europe. Tesla is getting smaller inside a market that's getting bigger. That's the worst thing that can happen to a company valued on the idea that it's going to dominate. Because look at who is growing. BYD, Chinese automaker, sold 2.26 million EVs in 2025. Tesla sold 1.64 million. First time ever, full calendar year, Tesla is not the biggest EV company in the world. And it's not even close. BYD outsold them by almost 40%. I need to slow down on that because Tesla's entire valuation story assumes dominance. It's supposed to be the Google of electric cars, the one that wins so big, nobody else matters. But Google has 90% market share in search. Tesla's global EV share is actually going down. It dropped from about 20% to 17% in 2025. So maybe it's not about volume. Maybe Tesla wins on profits, on quality of revenue. I looked at that next, and this is where I really felt something shift. Tesla made $12.6 billion in profit in 2022. That was the peak. In 2025, about $3.8 billion. That's a 70% drop. In 3 years, earnings fell in 9 of the last 10 quarters, and revenue went down for the first time ever, from $97.7 billion to $94.8 billion. Oh, and there's a detail most people miss. For years, a real chunk of Tesla's profit came from regulatory credits. Other automakers buying Tesla's emissions credits to meet environmental rules. Some quarters, that was the difference between profit and loss. But as other companies make their own EVs, they need fewer credits. So that cushion is disappearing, right when Tesla needs it most. And the stock? Higher than it was at peak profitability. I want to say that again because it sounds wrong. The market is paying more for a company that earns less, sells fewer cars, and faces more competition than ever. Let me give you the valuation picture. Tesla's price to earnings ratio is about 313. The auto industry average is about 18. That's 17 times higher. But forget car companies. Compare Tesla to other trillion-dollar tech stocks, its supposed peer group. The next most expensive one trades at a PE about 75% lower than Tesla. For Tesla to match just the second most expensive mega cap tech stock, it would need to fall by 3/4, from around $400 to around $100. This isn't expensive by car company standards. This is expensive by any standard that has ever existed. And then I looked at Europe. I was not ready for Europe. Tesla's sales dropped 45% in Europe in January of 2026. Just that 1 month. For all of 2025, down 39%. Meanwhile, the European EV market as a whole grew. BYD's European sales up 240%. So the market isn't rejecting electric cars, it's rejecting Tesla specifically. To be fair, part of that is more competition. But it's not just competition. There are protests outside Tesla's factory in Berlin. Sales collapsed in France. Scandinavia used to be a Tesla stronghold. Not anymore. Surveys show that Musk's political activities have turned the brand toxic for a big chunk of European buyers. The brand used to mean environmental consciousness. Now it means something else. And people are taking note. That's when I started thinking about the people who are inside those numbers but never chose to be. Another composite here, Patricia, 58, hospital administrator in Cleveland. She's never bought a stock in her life. Doesn't follow markets. Couldn't tell you what a PE ratio means. She has a simple strategy. Every paycheck, money goes into her 401k. Target date fund shifts toward bonds as she gets closer to retirement. Patricia has no idea she owns Tesla, but she does. Her fund holds S&P 500 index funds. Tesla is about 2% of that index. She's got roughly $320,000 in retirement savings, so about $6,400 is sitting in a company she never once thought about. She said something that hit me. She said, I thought the whole point of diversification was that no single company could hurt me. Yeah, that's what it's supposed to mean. But when one company is valued at $1.47 trillion on a business this shaky, there's a hole in that logic. If Tesla repriced to match its actual fundamentals, Patricia loses thousands without ever making a single decision about Tesla. And she's not unusual. Anyone with a pension, life insurance, the passive investing revolution spread Tesla's risk throughout the entire financial system. People who have never heard of Elon Musk carry consequences if his business fails. That's what systemic risk actually looks like. It's not a choice. It's an inheritance. So now I'm holding two pictures. A business that's falling apart by every measure, and a stock price that doesn't care. So I kept asking, what's actually maintaining this gap? And I started mapping the forces. And it's not one thing, it's a system. A bunch of structural forces all pushing in the same direction. Start with who owns the stock. About 47% institutions, 16% insiders, mostly Elon Musk, and 37% retail investors, regular people buying on their phones. Now, that retail number is wild. Most companies this size are 80% plus institutional. And it matters because institutions do the thing that's supposed to keep stock prices honest. They build models. They set price targets. When the fundamentals get worse, they sell. That's the self-correcting mechanism. For Tesla, that mechanism is broken. A lot of retail Tesla shareholders didn't buy a stock. They bought a belief in Musk, in the mission, in the future. When the stock drops on bad news, they don't see a warning sign. They see a sale. They buy more. So good news brings new buyers. Bad news makes existing believers double down. The stock goes up either way. And here's what's happening underneath, quietly. During 2025, 123 institutional investors completely sold out of their Tesla positions. All of them. Gone. The professional money is leaving. Retail is pouring in. The investor base is getting less sophisticated, not more. Now, I checked that number twice because it seemed too high. It wasn't. Then you add passive investing, trillions of dollars flowing automatically into index funds. These funds buy stocks based on market cap. Tesla goes up, its weight in the index goes up, more money gets pulled in, the price goes up more. Nobody in this loop is asking if the valuation makes sense. There's no analyst, there's no fundamental check. Only math moving money. For years, ESG investing made this even worse. Tesla was the biggest holding in a lot of green investment funds. Only major pure play EV company. Too many green dollars chasing too few green stocks. More buying pressure that had nothing to do with the business fundamentals. I talked to another composite here, Daniel, 38, hedge fund analyst in New York. He started shorting Tesla in 2020, did his homework, wrote detailed research laying out everything I've just walked through. Valuation gap, competitive threats, declining fundamentals. He was right about all of it. He told me something I can't stop thinking about. He said, being analytically correct provides no protection against being financially destroyed. What happened was the stock doubled after the 2024 election. Musk's political connections became a tailwind. Retail surged. Daniel's fund lost tens of millions on a position that was perfectly researched and totally catastrophic. He covered at a loss eventually. He still thinks Tesla is massively overvalued. He just learned that being right doesn't matter if the market disagrees. And the thing that's supposed to make the market agree, short selling, the corrective force that brings overpriced stocks back to reality, it's basically been disabled. Short sellers who go against Tesla get harassed by the retail base. They face theoretically unlimited losses. And they're up against a CEO who can move the stock price with a single social media post, which brings us to the last piece. And I think it might be the biggest one yet. Musk doesn't just run the most valuable car company ever. He owns X, formerly Twitter, one of the biggest social media platforms on the planet. Over 200 million followers. He can move his stock with a tweet. He can go after short sellers, attack journalists, redirect attention from bad earnings to some exciting future announcement whenever he wants. No CEO in history has had this kind of power over the narrative. Normal executives have PR teams, legal departments, boards telling them what they can and can't say. Musk doesn't have those constraints. And around him, there's this whole ecosystem. YouTube channels, podcasts, Reddit communities, Twitter accounts, all amplifying the good stuff and explaining away the bad stuff. Financial media plays into this too, mostly without meaning to. Tesla stories gets clicks. A robotaxi headline gets way more traffic than a headline about shrinking margins. The attention economy rewards the exciting story, not the accurate one. So now I can see it, the whole machine. Retail conviction that buys every dip. Passive fund flows that buy automatically. Short selling that's been destroyed as a corrective force. Narrative control that shapes what information people even see. Each one reinforces the other. Together, they hold up a valuation that has almost nothing to do with the actual business. Daniel said one more thing that stayed with me. He said these forces aren't some temporary glitch that'll correct itself. They're structural features of how modern markets work. He said valuation analysis, the fundamental tool of his whole career, doesn't apply here anymore. And he said he doesn't know what actually does. Once you see the machine, the next question is obvious. Who benefits from keeping it running? Start at the top. Musk's net worth is almost entirely Tesla stock. His pay is tied to stock price targets, not sales, not profits, not cars delivered, stock price. Every dollar the shares go up makes him billions richer. So, of course, he's going to maintain the story that keeps the price up, regardless of what the business is actually doing. Early employees with stock options benefit too. Their paper wealth holds as long as the stock holds. Retail investors who bought early have built their whole identity around this. Selling means taxes on years of gains. It means admitting the thesis might be wrong. It means giving up the story they tell about themselves, that they saw something others missed, had the guts to hold when everyone else doubted. For a lot of these people, the psychological cost of selling is actually higher than the financial risk of staying. Think about that. It costs them more emotionally to sell than to hold a stock they're not sure about anymore. And the broader market benefits too, because as long as Tesla can hold $1 trillion valuation while its fundamentals are cratering, it proves something. It proves that fundamentals don't have to matter, that story and momentum and belief can keep prices up indefinitely. And that gives cover to almost every other speculative bet in the market. Marcus, the software engineer from earlier, he's been watching all of this happen. He reads the delivery numbers each quarter, sees the decline, sees BYD, sees profits down 70%. He told me something that I think captures exactly where a lot of people are right now. He said, I can't explain it to friends anymore. Why it's worth more than the whole rest of the industry combined. When they ask, I talk about full self-driving, robo-taxis, Optimus. But even as I'm saying it, I can hear how it sounds, like promises, not products. He still owns every share. He said the certainty that used to feel like wisdom now feels like something else, and he doesn't know what to call it yet. Here's where I've landed after months of pulling at this. Tesla sales are declining. Profits have collapsed 70%. It's lost its crown as the biggest EV maker. An entire continent of consumers is walking away. It trades at 17 times the industry average. It's worth more than the next 29 automakers combined while making 2% of the world's cars. And none of it matters to the stock price. Something else is holding this up. Something that doesn't show up in quarterly reports or delivery numbers. Something powerful enough to override every signal the business is sending. Now, I've shown you the numbers. They don't add up. They can't. A mid-sized manufacturer is not worth more than the entire rest of its industry, not on the business as it exists today. So the valuation has to be on something else, something the market believes is coming, something that, if it arrives, changes everything. And if it does arrive, changes everything in a different direction. That something is a promise. One promise, made over and over for 10 years. And what I found when I started pulling at that thread, it's not just that the promise hasn't been kept. It's that it's been made and broken and remade so many times that the pattern itself becomes the story. A story about the difference between a company that will build a future and a company that's really, really good at saying it will. That's part 2. I'll see you there.